Welcome, everyone. I couldn't be more excited about the interview conversation I'm about to have. He's been a big supporter of AIME. He does phenomenal things for us. Everyone knows and loves him. He's a, he won the Global Award 100, top 100 in 2020. He won the Crystal Ball Award twice, and I really want you to dive into that one. The only person to ever do it, top forecaster. And one thing that I really want to give Barry props about is the fact that at all of our conferences that we've had, he sat there and predicted what was going to happen in the coming years. And I just want to welcome everyone to this great conversation with Barry Habib. And he hit the nail on the head with his predictions. So first off, Barry, thanks for joining us today.
Mark, it's always great to be with you. And hello to all of my dear friends at AIME. Love this group of people.
And I'm telling you, our members absolutely love you as well. So, Barry, let's touch base on this here really quick. Obviously, everyone knows your awards. You're top at what you do with forecasting. But at one of our conferences, you talked about what you thought the future was going to bring with rates and everything in a little recession. So why don't you touch base on that for us?
Yeah, I know everybody thought I was crazy when in 2019 I said there's going to be a recession in 2020. We did, the technical entry point was in February. That's before all the lockdown. So of course we had COVID, but before that we did enter a recession. We knew that was happening. We knew that rates were going to drop. I know that the 10-year treasury was like at 2.8, and I'm talking about on Fox and CNBC and all of our shows here saying it's going to 1, and people thought I was nuts, but sure enough, it did hit 1% in January, and then we obviously went down below that, and we are still below that right now as we speak. So what I'd like to talk about is, let's put our neck out on the line again, and let's try and forecast where we see rates, where we see real estate, and what you need to be doing to really win in 2021. I can't believe here we are at the end of the year already, man. It's crazy how quickly time passes. So there's a lot for us to look forward to as we head back to a more normal life, God willing, with now hopefully approval and then distribution of vaccines beginning here in the U.S. It's going to be a lot for us to look forward to. I can't wait to see all of you guys and do high fives and hugs and get together with you in person.
Trust me, I'm with you. We did our national event virtually, and it went great for what we had, because I always say our community is the most adaptive community out there, and it went great, but it just it still wasn't the same. There still wasn't that collaboration that we could do, but still, I'm with you. I can't wait to get back to that. So and I'm telling you, it's coming. I'm really highly optimistic on this, but the main thing we want to talk about with our conversation today, and I know that I trust you the most when it comes to this, especially with a new president coming into place, COVID. Everyone's talking about what are rates going to do? Is housing still going to be affordable? Or what's going on with forbearance? I mean, I could go on and on with the questions I get, and none of us really have that crystal ball. But if there's somebody who's the closest to it, it's you. So could you touch base on some of that?
Well, yeah, thanks for your kind words. So I don't see too much of an influence on interest rates based upon that, but the new Treasury Secretary will certainly be able to make an impact, and that's Janet Yellen. I'll talk about that. With regards to some of the things that affect us, it appears that regulation is going to be tighter. So the CFPB will have more teeth. It's something that we're just going to have to deal with. It probably adds a little bit more of a layer of cost, unfortunately, and probably creates a little bit of a slowdown in the process, which, that's also going to be a burden that we're going to have to more than likely put on the shoulders of this industry. But boy, this industry unbelievably resilient. I mean, throw anything at it and we seem to adapt, whatever the regulations are, as crazy as they may be, as silly as they may be. And then in addition to that, you take a look at what's going on with working from home and processing loans from home and all the pressures that is on it. This industry is amazing how it adapts. I mean, God bless you people. It's just incredible what you are doing.
Well, thank you. Yeah, I mean, just like I said before, we're so adaptive. But the great thing about it is with this association, we have such great lending partners and vending partners that allow us to do what we do from home. I mean, our industry actually grew during this time when a lot of industries were falling apart. So no, I mean, I'm blessed to be in this business. I truly am, and I know a lot of people. We have more and more people coming on. So it's phenomenal.
So Mark, I have some slides. I can try and just go through them pretty quick, but I wanted to give people a taste of what I think the forecast for the year would be and why, more importantly.
I'm going to tell you right now, I'm all eyes and ears, and I'm sure our members are as well.
All right. So I'm going to share my screen. So here we go. I'm going to do that right now. And let's just make sure that You guys can see that.
Sure can.
All right. So, by the way, Mark, my book, Money in the Streets, I'm so blessed, that was released a couple of months ago, and just a month and a half ago, hit #1 on Amazon's bestseller list for new releases. It just, I got to tell you, man, I was, when I found that, I was literally, I got choked up. I was in tears. But it's a great book. If you haven't picked it up for yourself, Amazon, Barnes and Noble, wherever. But I think the reviews are through the roof on it. I mean, it's people. If you're having any kind of difficulty, which we all do, we all suffer, right? We all have difficult times. It'll help you get through it. If you're having a good time, if you're having a tailwind behind you, those good times, it'll help you maximize that. And that's very important. And then the other thing is it'll help you find opportunities that so many people are missing. So I hope you get a chance to pick that up. Anyway, she's back. She's back. Janet Yellen. Now, I didn't think she was a very good Fed chair, but so let's give her a chance at being the Treasury Secretary. She didn't do that great a job as a Fed chair, so let's give her another shot. Another extraordinarily important position. Hey, look for her signature. It's going to be on all the money. So she will be signing all the bills there. That is Janet Yellen. And Janet Yellen did not meet a spending program that she did not like just yet. So she loves the open pocketbook philosophy. And that's interesting because the current Treasury Secretary, Steve Mnuchin, has been butting heads with Jay Powell. Now, look, Jay Powell, maybe he's a little crazy too, because look, do we really think the Fed needs to be buying bonds of McDonald's and Apple? I mean, is Apple hurting that bad that we need to be buying their bonds? Well, according to the Fed chair, he thinks we should. He wants to buy everything. So what does this mean for us? It means that Janet Yellen will bless everything he says. She'll be his biggest cheerleader. So one of the things the Fed's thinking about doing is buying more longer dated maturities, like mortgage bonds, like 10-year treasuries, 30-year bonds. So if the Fed starts doing that, that will put pressure on rates to be lower. It will be something important that we have to look for, because if that does occur, you're going to be in good shape with interest rates. Now, meanwhile, interest rates have been ticking up a little bit. Why? Because of inflation. We've been seeing that. And that's because you've seen a little bit of a spike in demand, although it's been more subdued now due to the increase in COVID cases. But supply chain's not there yet, because we've got about 10 million people more, unfortunately, unemployed than normal. So a little tough to meet the demand, and that causes prices to rise a little bit. We're seeing a little bit of a hint of inflation, not a lot, but just a little bit. Thing of it is, though, is that bonds, mortgage rates do not like inflation. And mortgage rates, as we look at them here for the last 50 years in blue, they are not the same as the Fed funds rate. Fed funds rate and mortgage rates, two different things. You can change the Fed funds rate every day, literally. Mortgage rates, if you take out a 30-year mortgage, that rate's, you got to live with that for 30 years. So it's going to be much more influenced by inflation. So your customer thinks they're the same thing, but they're different. So when you take a look at this chart, you'll see there are periods of time where the Fed funds rate goes up, mortgage rates go down. You can see it over and over again. Fed funds rate goes down, mortgage rates go up. Over and over this happens. Now, this is a 50-year period, but your client doesn't have 50 years to pick and choose when to lock in. They've got a small window. And during those periods of time, even if the Fed's at zero, mortgage rates can rise. Let me show you something. Last time the Fed was at zero was between 2009, 2016. Here, Fed's at zero, flat line, right? But during this period of time, look what happened to mortgage rates twice here. Mortgage rates went from 4% to 5 1/8, like a 4-month period. Now, that would be quite shocking. That was quite shocking. So we could see that. Now, it didn't just happen once, happened again. Fed's at zero, okay? So with the Fed at let me go back. With the Fed at zero, we see mortgage rates go from 3.5% to 4.75%. Again, all while the Fed is at zero. That's a pretty big move. So that's happened a couple of times. Now, you were kind enough to mention some of the forecasts that I did, and everybody knows that, when the 10-year treasury was 2.8, we talked about it going to 1%. Everybody thought I was nuts. But we got it right. We got it right. It went there before all the lockdowns. We hit 1%. And after it went to 1%, said, okay, where's it going to go now? And they had me on Fox and CNBC. And when I said it's going to 0.5%, people were yelling at me and debating with me. Like, you could pull up the tape. It was like, I want to debate you on that. Didn't take long. It took 3 days after my appearance for it to go to 0.5%. So why? Telling you this, not because I want to take credit for a good forecast, but because I want to say to you that my predictions for where interest rates are going are based on the same methodology. And what people don't understand is that debt, the larger the debt, lower the interest rates, because debt causes growth to slow. Slower growth means less inflation. Less inflation, rates can go lower. And I believe that we are in a situation where debt is actually higher than it was. In 2019, our debt was tremendous, 22 trillion. And 22 trillion is a big number, man. You know, $1 trillion, we become like immune to it. But, you know, Mark, if I said to you, hey, take $1 million and spend $1 million a day, every single day, even for guys like us, that's hard to do, right? Spend $1 million a day every single day. How long would it take you to spend $1 trillion by spending $1 million a day? And I think for most people, it'd be surprising that it would take 2,700 years.
Wow.
You would have had to start 700 BC to reach $1 trillion. So the point is that $1 trillion is an awful lot of money. And now the debt's gone from 22 trillion to 27 after the stimulus deal that will probably get 29 trillion. That's going to put downward pressure on rates. So I know everybody's predicting rates to go up, but I think longer term, between technology keeping inflation low, that rates will behave themselves and be pretty low. That doesn't mean they can't have interim spikes. You saw that on the previous slide, right? You can have periods of time when they go up. We get a little bit of inflation. We can see that. And why is that so important? It's so important because right now, half of all mortgages are below 4%. And if most people need a 0.75% incentive to do that, that means if mortgage rates did hit 3.25%, which, you know, I know that today, could you imagine you quote somebody 3.25%, they say, oh my God, that's so high. But
they would laugh at it.
Yeah. For my entire career in this business, which is over 30 years, for just about, you know, except for the past few months, 3.25% would have been like a dream come true for low rates, right?
Right.
So almost an inconceivably low rate. That rate would be too high now. But the point is this: stay on path of doing your share purchases. Don't not do refinances. Do refinances, but don't ignore purchases. Don't think it's always going to be like this, because every single day that number goes up from half of all mortgages. Because every time you do a mortgage for somebody and refinance for somebody, you're increasing that number of people that have a mortgage. That's a very low number. And that means that there's less rate and term refinances. Now, understand this. As of today, CoreLogic said that in the last year, people gained 11% equity in their home between the mortgage pay down and amortization and appreciation. That tells you that anybody in the past that you've done with an MI loan, call them, refi them, get rid of the MI, save a little bit of money in rate. You have a great opportunity in front of you. And I want you to just stay on top of this team, because look, this is the time to raise your game. This is the time to create generational wealth. How long will this last? It's hard to say. But if you need to invest money in yourself, this is the time to do it. First, make yourself better. Get trained on stuff. You have the money to do it. Get yourself certified in CMA so you can convert more opportunities, because fintech's out there and they've got all this public money behind them. They've got a ton of headset jockeys that want to take money away from you and your family. So what you have to do right now is you get better. And there's no excuse. Don't give me the bullshit that, hey, you know what? I don't have time. You don't have time? Figure it out. That means you got to hire people. If McDonald's said in 1955, if they said, hey, you know what? We've got this great business, but we're too busy to think about how to get better and grow, they would today be one store in San Bernardino, a busy, successful store, but one store. So are you looking at it that way? Or are you looking at it to grow? If you're looking at it to grow, sharpen your skills now. Get all the tools you need now. Get certified now. And most importantly, hire the people you need to hire on your team and get the investment in yourself and your family going so that you can make as much money as possible during this incredible period of time, because it will not last forever. Now, here's
Barry, real quick, I just want to applaud you on that. That's stuff that I'm telling you, we've been preaching, and I want everyone to understand that now is the time. Not a lot of excuses. Yes, I want to make sure everybody's mental well-being is great, but we have the money. Figure out the time, hire people, staff up, get ready for a great year.
It is going to be a great year. And here's the thing too, is housing is going to be great too. But all these idiots are out there talking about, no, housing's not affordable. Dan, yesterday gets on CBC, said there's an affordability wall. Really? First thing they do is they all get it wrong. You know, even our friends at some of the publications that you see that come out every single day, okay? And they're good people that put this stuff out, but this stuff is not easy to understand, which is why I'm trying to explain it to you in a way right now that helps you really get this down. So affordability right now is the 7th best affordability ever. So how in the world could affordability be so good if home prices are going up? Okay, so first thing we have to do is we have to understand what are the right measuring sticks to use. So you see in the media, I saw it in all the publications in our industry, where they say, oh, well, we're worried about affordability because appreciation is up 15.5%. In what world are you living? 15.5% is not true. That is the median home price. That is not appreciation. The median home price means that half the homes were purchased above that level, half the homes below that level. So when we take a look at that, there's no homes available at the lower end. So that means fewer homes purchased at the lower end skews the median home price higher. That's not appreciation. Appreciation, as measured by Case-Shiller, shows that appreciation is still robust, but that's up 7% over the last year. Now, people say, okay, 7% appreciation, incomes are not going up that fast. And they look at hourly earnings going up at about 4%. Well, you don't look at hourly earnings because you can work less hours or more hours. Nobody looks at this number. You should. It's called weekly earnings. Weekly earnings are up, get this, 5.9%. Pretty close to the 7% appreciation. So you can have the naysayers still going to say, wait a minute, homes go, okay, Barry, I'll give it to you on all that stuff, but homes are still going up at 7, income's going to 5.9, it's becoming less affordable, right? Wrong. Let's explain why income does not have to keep up with appreciation dollar per dollar. Here's why. If you were going to buy a home last year, and I'm just going to use these numbers conceptually, and last year that home would have cost you for a P&I payment $1,000 a month, just P&I, your income would be about $5,000 a month to qualify for it. I'm just using the averages from Fannie and Freddie. Now, if you didn't buy it last year because you heard all these crazy people, Adam Data, the Crash Brothers, Diana Olick, and so many, and you did not buy the home last year for $1,000, that you could have paid $1,000 a month, and you waited this year, if that home only went up 5%, okay, that means your payment went up $1,000 to $1,050, 5% more, right? So it went from $1,000 a month last year. If you bought it this year, you'd have to pay $1,050 for the same type or similar home. Well, that means you went up $50 a month. How much did your income have to go up to offset it? You'd have to be making $50 a month more to offset the $50 a month more increase that it cost you for the same home. Well, is that a 5% increase in your income? No, it's a 1% increase. So when you see incomes today going up at 5.9%, if prices appreciated 10, 15, 20, 25%, so long as interest rates stayed about the same, guess what? Your home got more affordable, not less. Let's look at one example to really tie it up here. So let's just say somebody wanted to buy a home this year and there was 7% appreciation. So the home that they're buying this year is $350,000. Well, it appreciated 7% over the last year, which means last year it was selling for 7% less, or about $327,000. So it's gone up about $23,000 in value. Well, the 30-year fixed mortgage rate last year was 3.75. Today it's 2.75. So you've saved 1% on rate. What does that do to your loan amount? Well, your loan amount had to go up because the home is more. So this is what you're going to be borrowing an almost $21,000 more. Instead of $294,000, you're borrowing $315,000. So what does that do to your payment? Well, guess what? The higher mortgage on that lower interest rate is $77 cheaper than it would have been last year. How in the world are people saying it's not as affordable? It is more affordable, even though the price went up. Okay, hold on a second. Somebody's going to say, what about MI, Barry? It's a 90 LTV. You got to pay more in MI. You're right. So you pay $8 a month more in MI. Your net total is $69. Now, what about the negatives here? Here's the negative. The negative is this is a little bit more expensive home. You need a little bit more down payment. Instead of $32,700, it's $35,000. So you got to put up, let's call it $2,300. But if you took that $2,300, that $2,300, by the way, is about $10 a month if you bought it into the mortgage. Mm-hmm. So roughly, you're still saving about $60 a month, roughly, than it would have been last year. And that's if you finance the difference in down payment, if you took out the higher mortgage interest, all those things, it's still $60 a month cheaper. But wait a minute, here's the big one, Mark. The monthly income increase of 5.9% means if you were making $5,000 last year, you're making $5,300 this year. So not only is your payment $60 a month less, but your income's $300 a month more. The affordability issue that all these bozos are out there trying to strike fear and scare you guys is BS.
That's phenomenal. That slide right there. It kind of sums it all up when it comes to affordability.
Yes. Now, Mark, here's something that many people don't realize is that you have been pixeled. So what does that mean? Being pixeled means this. It means that you went shopping. You shopped for shoes. You shopped for clothes. You shopped for household goods. You went shopping for a car. You did your Christmas shopping. And when you went to all these sites, guess what starts to happen? You go on Instagram. You go on Facebook. You go trolling the web. And you notice that, isn't that a coincidence? They are showing me ads for the exact item I was looking at. How'd they know that? That's because they pixeled you. And why do you need to know about this? Because if your client or your realtor's client wants to find out the value of their home and they go to Zillow to get the Zestimate, they're going to get pixeled. And guess which ads they're going to be shown? They're going to be shown ads for your competing mortgage companies and competing real estate agencies. So keep them out of there. Don't do that. Mark, did you know that 35% of refinances do not close? 35%. A big reason for that is because the value isn't there. So why spin your wheels? Why waste your time? Write an MBS Highway. Guess what we give you for free? Your own AVM. It's called the MBS Estimate. Pull up as many as you want. They're free. They're with an MBS Highway, and co-brand it with your realtor. What an awesome thing to do. This is one of the best tools. This thing is being used like crazy. Everybody is finding enormous value. Hey, if you're talking to a customer, pull up the value of their home before you waste your time. Max out the cash out that you can. It's just smarter to do so. Okay, now, why is that so important? Because you need to understand how to influence a buyer's mentality to make a good decision in making the right choice to purchase a home. Now, Mark, today, 56% of homes have multiple offers. 20% of homes are cash offers. So we created a tool that's never been anything like this in the history of the mortgage industry. It is the only thing like it, where we can help that buyer see if they should bid more to compete with a cash offer or over asking price. Here's a real one that we put together. So here's the deal. What happens is that the current asking price is 810. The AVM value, which is a 96% confidence, shows 808 is roughly the market value. So that's good. But let's say there's a cash offer at 800. Let's say somebody's bidding 810 full price. Somebody's bidding 820. In order for you to win this home, and make no doubt about it, to get a home today, you got to win the home. You've got to bid 830. Now, Mark, you and I, we don't like to pay full price for anything. So to go 20,000 over asking price, that's hard sell. So what do we do? Because you know what? Many people tell the realtor to say, take it out of your commission if you want me to go more. The realtor hates that. So why don't you help your realtor by showing the customer when will the value of the home eclipse what they're going to offer at 830, because it may shock you. In this particular case, we have the data that shows by March of 2021 in this real listing, all you do is put in the MLS number, March of 2021, the value of this home will be greater than 830. And guess what? If I'm putting in a contract in December, I close in January, February, by the time I make my first mortgage payment, the value of that home is already more than what I paid for it. Oh, and by the way, over the next 5 years, you're going to make $300,000 on the home. Now, Mark, what this does is it gets people to bid more. It makes the realtor happy. It gets you the deal, and it puts the customer in a better position to create wealth for themselves. Everybody wins. Now, if you like all this stuff, here's what you could do. You could have your own AVM, just like we do, on your own website to generate leads, to capture those leads, and you can take it one step further. You can take that AVM and co-brand it and put it on your realtor's website, so that your realtor can generate traffic. People that have been doing it, the realtor says, oh my gosh, the hits on my site go up so much that even when I go to a listing, I say, I'm going to feature it on my site, and here's how many hits I get, and they win the listing against somebody else. By the way, one of the things that you need to also be able to show to help your realtor is the cost of waiting. We've talked about this in the past. Yeah. I don't want to spend a lot of time on it, but it's a really important thing. It's included in our open house. Now, Mark, we talk about getting certified. The best deal that's out there is the deal through AIME. It is exclusive. Nobody has it. So we had a charter member discount. It was only the first 3,000 people that signed up, which within the first week, that got themselves certified. And by the way, if you go to Certified Mortgage Advisor on the Facebook page, look at the users group. The one review after another, life-changing, changed my life, can't believe it. Oh, never learned so much, put up against the college cost. I've gotten 3 deals from in the first week after getting it. I mean, this is just life-changing stuff. If you want to be the best that you could be, which why wouldn't you? Then AIME has created the best discount that's available. Even our Black Friday sale that we did for one day, which got about 500 people sign up on it, was not as good as this. AIME can get the best deal out there. If you're an AIME member, you get a $300 discount. But if you're an AIME member with an MBS Highway membership, that's a $500 discount, which is exactly the same discount that was offered when we did a charter membership. The code is CMABAB, and you go to becomecma.com. So instead of it being $19.97, you're going to pay $14.97. That is the best price ever issued to anybody. I strongly suggest that you take advantage of this. And by the way, if you're not a member of MBS Highway through AIME, they've got a great deal. I mean, are you freaking kidding me? You're not a member of MBS Highway? I mean, really? I mean,
yeah, I use it. I use it quite a bit.
Why? You've got like the best discount out there too. So you go to mbshighway.com/brokers are better, and bingo, get yourself set up. Mark, we tried to do that super quick. I feel like, like Berman on ESPN trying to go through this stuff, So we're back. Fastest 3 minutes, and it was like the fastest 15 minutes.
But no, really, really impactful. I mean, it makes you think about things a lot differently. And kind of what we're doing here is we call ourselves experts, because I truly feel we are. And that's just, that's just more ammo for us right there. I absolutely love that slide. And yeah, I mean, I know we went through it pretty fast, but it was so impactful.
Well, good, brother. Good, brother. I'm always happy to be here for you guys. You can always count on me. I can't wait till we start seeing each other in person once again.
Yeah, Barry, I have one question for you, then we'll close this out here. And by the way, I promote everything Barry does. His products are absolutely amazing. But going into 2021, I know we kind of touched base on this, but what's one bit of advice you can give to our whole community to have a successful 2021?
Fintech's coming after you. All this public money means they're going to hire a bunch of headset jockeys to beat you. Don't let that happen. There may be fewer leads, convert more of them, brush up on your skills. Really, I mean, tools like MBS Highway and tools like, first of all, being an AIME member is critical, but tools like the CMA will help you convert more of them. And I thank you for saying that, you support what we do and you trust us. And I think the industry knows we would not put something out unless it was really, really, really good. I feel like we've over a long period of time, people know we're not out there to try and give you something that's not going to really make a difference or change your life. And by the way, anything that you purchase from us, if you are not blown away by it, just tell us. We give you money back. We don't ask any questions. So you need to just get better. That's what you have to do. The idea for you is raise your game, build your business. We talked about this. Hire the people that will help you take advantage of this opportunity. You don't want to be looking back and saying, oh, wow, I had good numbers this year. I made good money. But now when things slow down, that was just some extra money you made. Instead, make it change your life. Make it change your family's life, because you can rack all this in. Remember the McDonald's example, okay? Mm-hmm. If they thought small, if they didn't invest in themselves and they didn't start to grow, they'd be a really successful one-store burger shop in San Bernardino, California. But instead, they built an empire. I want to see you in 2021 build your empire.
Barry, as always, thank you so much. Love everything you do for us. I know this will be highly watched, and I cannot thank you enough for everything you do for us.
God bless you guys. Thank you.
Thanks, Barry. Everyone, all of our members, we'll see you next time. Thanks for joining us.